cash reserve ratio and statutory liquidity ratio. Demand and time liabilities. So here we will see what is demand liabilities, what is time liabilities, and we will see some examples of that. So demand liabilities means current deposits, margins held against letter of credit, demand liabilities portion of savings deposits, balance in overdue fixed deposits, cash certificate and recurring deposits, outstanding demand drafts, unclaimed deposits, etc. So those falls under the category of demand liabilities. Now what is time liabilities? It means fixed deposits, cash certificates, time liability portion of savings bank deposits, cumulative and recurring deposits, margins against letter of credit not payable on demand. So these are time liabilities. Now there are also other demand and time liabilities, which includes bills payable, deposits, unpaid dividends, participation certificate issued to other banks, sundry account balances, etc. So these demand and time liabilities are categories of deposits which are with the bank, and based upon which we will see cash reserve ratio and statutory liquidity ratio. So that is our next point. What is cash reserve ratio or CRR? So cash reserve ratio is a ratio of bank's cash reserve which ensures a bank's liquidity and solvency, and is based on cash reserve balance of a bank with the Reserve Bank of India with reference to bank's net demand and time liability. Under the RBI Act of 1934, banks keep a minimum cash reserve with RBI. Earlier it was 3 to 20%, now it is different. It's a range of banks' net demand and time liability. But after the RBI Amendment Act of 2006, RBI at its discretion is empowered to fix the CRR without any floor or ceiling. So on a daily basis, the amount is the minimum 70% of the average balance with effect from 2002, where non-scheduled banks maintain a CRR of 3% of net demand and time liability, and RRBs also maintain the same CRR as applicable to scheduled commercial banks. So in short, banks add a certain amount of deposits on as reserves with central bank, which is the Reserve Bank of India. It is either stored in bank's vault or is sent to RBI. Banks can't use this money for investment, and banks don't earn interest on this money. So that is what is cash reserve ratio. Now what is statutory liquidity ratio or SLR? Statutory liquidity ratio is according to section 24(2)(a) of Banking and Regulations Act 1949. It requires that every banking company in India maintain in India an amount not less than an amount as prescribed by Reserve Bank, which was earlier 25% of total net demand and time liability at the close of business on any day. The Reserve Bank of India can change the requirements of SLR with a minimum amount at its discretion and a maximum amount of 40%. So in other words, SLR is a percentage of deposits a bank maintains in liquid cash, gold or other securities. Before offering credit to customers, it is a reserve requirement that banks maintain this balance. The reserves of the commercial bank are not kept with the Reserve Bank but with commercial bank themselves. So that is what is statutory liquidity ratio. Next we will see what are the comparisons between CRR and SLR. So there are provisions for legal basis, present or not, kept as, return to RBI and interest. So legal, it is section 42(1) of the RBI Act is applicable to CRR. For SLR it is section 24(2)(a) of Banking Regulations Act 1949. The basis is it is as percentage of NDTL or net demand and time liability at fortnightly average, whereas SLR is percentage of NDTL on daily basis on last Friday of second preceding fortnight. Present or non, 6% as on April 2010, which is CRR. SLR is 25% as on December 2010. Now what is it kept as? CRR is kept as cash balance with RBI. SLR is kept as cash in hand, investment and gold in approved securities. Returns to RBI, it is in Form A fortnightly. What? It is CRR. SLR, it is Form 8 on 20th of every month. Interest, there is no interest payable on CRR, whereas SLR as per investments in different securities. So this wraps a session on cash reserve ratio and statutory liquidity ratio. Thank you.